Alrighty, it is Chuck, Mike, and Tucker with you, and we are holding in our hands right now just a whole bunch of no longer AAA rated by Moody's U.S. government debt.
Very.
When did they get rid of bearer bonds? It had to be after Die Hard, because that's what...
I was going to go 90s.
I'm curious when it was, because you can't actually hold U.S. Treasuries in your hands anymore. But you used to be able to back when you had bearer bonds, which quite honestly, as the name implied, was just, hey, if you are holding it, you own it. Like, 82. That was the deal. 82 was the last ones that they had?
Yeah. The issuance ended in 82. I assume that you could still have a bearer bond after that, but they didn't get issued anymore.
So realistically, the longest duration that they were was probably 30 years. So the last U.S. Treasury that could have been in bearer form went away by 2012. Is that right?
That would seem
I don't even know if
me.
they were issued in that
Can we
kind
explain
of...
what a bearer... I mean, it's
literally
the holder of the bond owns the value.
Yeah, I just did.
Okay, sorry.
Yeah. It's okay. You were Googling or something.
I was, yeah.
But so in any case, over the weekend, actually it was Friday at around 4:30, Moody's, who is one of the three major U.S. rating agencies, aside from Standard & Poor's and Fitch, decided to say, hey, you know what? We don't think the U.S. deficit picture is that sustainable anymore, and as such, we are going to downgrade you from the highest possible rating to one level below there.
Where you been, Moody's?
So this is the thing about Moody's, is they are widely viewed by Wall Street as the class clown of rating agencies. And it's not to say that, like, they don't have smart people working there. I'm sure they do. It's nothing about, like, the individuals at Moody's. It's much more, look, S&P downgraded the U.S. back in, was it 2011 or 2012? I can't remember which one now.
You told me 2011 earlier today, so I'm going to go with what you told me earlier.
I'm just pulling it up just to make sure. Okay, here we go. So the S&P downgraded them back in 2011, which, by the way, also happened, I think it was like 8:30 on a Friday when they did this. So this wasn't...
That was a big deal. They were first to the scene.
This wasn't Moody's It wasn't Moody's trying to, like, slip this by like a Friday news dump. This is just, like, when this happens because of the magnitude of it. They don't want to do it during active trading because of the stuff that it can cause. So they do it on a Friday so that banks and traders have a little bit of time over the weekend to actually think about it and figure out what they want to do with it.
And when this happened in 2011, it was pretty noteworthy, I think. We were on the heels of the Great Recession. There was a somewhat new idea that, hey, lawmakers might not extend the debt ceiling and hey, this could be an actual threat to the U.S. economy. We had just loaded up on a whole lot of debt in order to combat the effects of the Great Recession. And so this was pretty newsworthy and groundbreaking that, hey, a major agency is downgrading what is generally seen as the safest asset that exists.
There was a lot going on then, though. So, like, the thing that you come back to if you look after this is people be like, oh, like, stocks sold off, but bonds rallied. Like, who would have thought it? Well, part of the reason that bonds rallied was that the EU was kind of in the process of, having its every 10 years, oh, we're falling apart, what do we do?
Yeah.
That was like right in the midst of the Greek debt crisis and this and that, and so investors were like trying to figure out what's actually safe to hold. And so, again, I don't think that you can like read into this and be like, oh, well, bonds got bought up then and stocks sold off, so that's what's going to happen now. Completely different environment in so many different ways.
Agreed.
So you had that back in 2011. And the big thing that S&P cited then was questions about U.S. governance and policy-making stability.
That's gotten better since 2011.
If they could only see us now. So I think that, number one, like, S&P was first to the party on this. Was it right, wrong, or anything else? I have no idea. I'm not going to, like, say, like, whether or not they should have or should not, because obviously the United States has not defaulted in the 14 years since then. But they did this, and it is what it is. Other ones that you saw since then. Back in 2013, I'm not going to count like the non-major rating agencies.
Sure.
I don't even know what business there is for non-major ones, but apparently there's enough that there's actually like 5 or 6 of these guys out there. It's just no one really pays attention to the other ones. But in 2013, Fitch warned that it might cut the U.S. credit rating again, talking about political brinkmanship about the debt ceiling. In 2014, after the debt ceiling was punted, Fitch said, hey, we're, upgrading our outlook. We're not going to change, the AAA rating. In 2019, Fitch said, hey, we might, have to do something about this. And in 2023, with the debt ceiling crisis that happened then, Fitch put the U.S. on negative credit watch and then downgraded the U.S. from AAA to AA+. So last Friday, Moody's comes in and says, gosh, it's 2025. We should get in this party too. And so they downgraded the U.S. Debt from AAA to what they call AA1. They all have like their own
Slightly
unique
different
little
ones, yeah.
things, but AA1 is effectively the same as AA+ from Fitch and AA+ from S&P.
So I want to continue this, but I want to talk about where this does matter. Because like 2 weeks ago, for example, Whirlpool, the maker of washing machines, they own KitchenAid, Maytag. They were cut to junk status by S&P. Real-world implications for Whirlpool immediately. If you're cut to junk status from investment-grade quality, there are a whole bunch of investors out there, many, many investors out there who, by prospectus, are not allowed to own your debt.
Yes.
Many mutual fund managers must sell your bonds immediately. What does that do? It makes it immediately more expensive in the future to refinance your debt, to raise new debt offerings, etc., because you are given this brand of junk status, which is a certain threshold and below if you are an issuer of that debt. That is very fundamentally different than what we're talking about with the United States here.
In a couple different respects. The first is no one goes out and purchases, even when Whirlpool was, double B or something like that, no one goes out and purchases Whirlpool bonds being like, you know what? I made a bunch of dollars. I need somewhere safe to put this money for 10 years. Let me go put it in Whirlpool debt. Because if you're rated double B to begin with, even before you get downgraded from there, odds are that there are some questions about exactly what your next 10 years look like.
You're on the lowest level next to junk.
Correct. So, and there might even be mutual funds in the investment grade space that say, yeah, we're going to shy away from you because we have these specific concerns that we've researched. So it's not just like you hit a cliff. Like, people have already kind of shied away from you a little bit in a number of cases. In this case, and I'll go back to what happened during, the previous downgrades. One of the concerns out there is, hey, are there, insurance companies or pension plans that have to, liquidate because they can only hold AAA rated, sovereign debt? And all that most of those guys did back during all those previous, not all those previous downgrades, but the two previous ones,
Change the rules.
they just said, yeah, you know what? We can hold AA+ now.
And why? I think this is
Because they want to own U.S. Treasuries.
Yes, and they want to own U.S. Treasuries for a few reasons. One would be it's still considered to be, if not the most creditworthy, then one of the most creditworthy items that you can own. But two, it's also the most liquid. Well, and as a result of us having like a $27 trillion, $29 trillion, where are we now in terms of the total debt? Whatever. It's an incredibly liquid market for you to hold something that is quite considered quite safe.
Let's also not forget the third piece of this, which is when you're on a big boat with a cannon, you don't turn the cannon around and point it at your own hull. And if every insurance company simply said, you know what, we can't hold AAA rated debt anymore, we can't hold U.S. Treasuries because they went from AAA to AA+, then every insurance company instantly goes out of business because all of their collateral is worthless.
Yeah.
So, part of it is they can't actually do that because they would have no one to sell to.
That's an interesting analogy, Chuck, when you're talking about the U.S. debt ceiling, pointing a cannon at your ship's own hull.
Yes, well, listen,
it also applies to those who try to vote against raising the debt ceiling.
In light of what happened at the Brooklyn Bridge a few days ago, we're all kind of in nautical mode these days again, kind of like we were back in the winter of 2022 when the Ever Given got stuck in the Suez Canal, and so, hey, I'm just playing to the zeitgeist here with what everyone's focused on. So, big thing. The actual downgrade of the U.S. debt by Moody's, non-event. But, and this is a big, big but. I appreciate that, Tucker. I appreciate that. What this gets at is something that everybody knows right now. And everybody knows that everybody knows this, which is that you can't run deficits at 7% annually and expect to be able to get away with it without any consequences.
Right.
And,
so the time-
and Moody's has no unique insight into this, but the timing is interesting just because everyone's paying attention here right now. And what are the consequences as a result of that, in that, hey, could any interested party who wants to say, yeah, we want to use this as a rationale for changing what we previously did? That now is in play as what people can use for, hey, you know what? We're a company based out of, name any foreign country that's not the United States. We previously held, 100% of our, excess cash in dollars because we transact mostly in dollars. We're going to be looking for alternatives for, portions of this just to balance the risks that are present to us.
So Besant said over the weekend, I believe it was, that the downgrade is a lagging indicator. And while that...
Which, by the way, I got to tell you, calling Moody's a lagging indicator...
It's a good insult.
It's
especially from him.
It's kind of like... Who's the guy that got called a medium talent on SNL? Was it Chevy Chase by Bill Murray? I think it was.
I don't know.
I forget who it was, but it was just like just this biting thing, just like, oh, like you're not awful, you're just like a medium talent. I think it was Chevy Chase who got called that by Bill Murray.
Yeah, Bill Murray is yelling that at Chevy Chase. Medium talent.
This is basically like Scott Bessent calling Moody's medium talent. Like in the financial business, the last thing you want to be called is a lagging indicator.
Yeah. So I do not.
So I thought that was great, by the way.
I think it was a good insult. And in and of itself, I don't think it matters. I'm with you there. But it is another straw that has been piling on to the U.S. fiscal situation that, who am I to say? Maybe it does correlate and coincide this time with a real problem and change to the state of our... I'm not even calling it reserve currency, just our special status that the United States has had for the better part of a century.